Okay? In accounts, everything that we do is regulated by standards. All those items we look at in the income statement, the standards guide us how to record them. So we'll take a bit of time to look at a number of standards. The first standard that we'll look at is IAS 16, Property, Plant and Equipment. Now in all these standards, there are 5 main areas that you need to be comfortable with to enable you to pass the exam. The first is the definition. How is this standard defined according to the standard? The next is recognition. Then you've got measurement. Then you've got disclosure. So start with the definition of a PPE. A PPE is defined as a tangible item. A tangible item that is held by an entity for use in the production or supply of goods or services or for administrative purposes. It should be a building you're using yourself, the owner, not with the intention of selling it. And you are expected to use this asset for more than one period. Okay. Notice we use a period, we don't use a year, meaning from one financial year to the other financial year. How do we recognize it? We use the conceptual framework recognition criteria. And the conceptual framework recognition criteria states that a PPE should be recognized if it is probable that future economic benefits that are attributable to the asset will flow to the entity, and the cost of the asset can be reliably measured. If it meets these 2 criteria, we recognize it as a PPE. After we recognize it as a PPE, then we measure it. The measurement is divided into 2. There's measurement at recognition. At recognition, a PPE is measured at cost. The cost we include the purchase price, how much you paid for this asset. If this asset was imported, you had to pay shipping charges, you had to pay import duties, all those costs should be included. But you less any non-refundable taxes, not non-refundable taxes, but you less trade discounts and rebates. Non-refundable taxes, those are included in the cost. Then you add to the costs any directly attributable costs. These will include such costs as, let's take for example, you are constructing a building. You have to clear the site of that constructing where the building is going to be constructed. So those costs of such preparation, the building, the construction, if the building has to be tested to consider it fit for use, all those costs you add them together to give you the cost. On top of these costs, we have 2 other costs which come from other standards. The first of these ones comes from IAS 37 provisions, contingent liabilities and contingent assets. IAS 37 requires us that if you're going to incur a cost in the future to dismantle or remove an item or asset, that cost, you need to make a provision for it. But IAS 16 also requires that that asset, once you make a provision for it, that cost you need to capitalize it with the actual asset itself. Once you capitalize that provision, you then be required to unwind the discount. Okay. We will look at IAS 37 again in more details and what to unwind really means. The next cost is finance costs. Finance costs are simply interest payments. When you borrow money, a loan from a bank, you are required to pay interest. That interest, if the borrowing is on a qualifying asset, the word qualifying should always be there in the answer. Okay. Qualifying simply means that this asset will take a substantial period of time to make it ready for its intended use or sale. The standard IAS 23 borrowing cost requires that this borrowing costs be capitalized together with the cost of that asset which is being constructed. Clear? We will look at borrowing costs again in more details. There are conditions which have to be met there. So when we come to the standard itself, we'll look at the conditions required for you to capitalize. Then we have subsequent costs. These subsequent costs, the standard requires that if they meet the recognition criteria, these subsequent costs should be capitalized. An example of such costs would be where much dust. Where you are replacing the interior of an aircraft, or you are replacing the engines of an aircraft. Okay. These costs, they should be capitalized separately. After measurement and recognition, we have measurement after recognition. Now, from recognition, the entity is required to depreciate the asset over the useful life. Depreciation is simply recognizing the benefits that you are enjoying by using that asset. So that benefit, we take it as depreciation, which is an expense in the profit and loss. So at the end of the year, you've got cost minus depreciation equals carrying amount of that asset. So measurement after recognition is at the end of the year. How do you measure this asset now into the next year? The standard allows the entity to either continue using the cost model. If they continue using the cost model, the PPE will be carried at cost less accumulated depreciation and impairment losses, if any.